Imagine waking up on January 1st, 2026. You have a small portfolio. Maybe it's $500, maybe $1,000, maybe even less. Not zero this time, but close enough that it still feels like you're at the bottom of the mountain. The financial headlines are still screaming about interest rates, AI replacing jobs, and markets moving unpredictably. Most people look at that situation and think it's too late. They assume Warren Buffett got rich because he started early or because the game was easier back then. But the truth is, if Warren Buffett woke up in 2026 with a small portfolio, he wouldn't complain, he wouldn't wait, and he definitely wouldn't gamble. He would follow a system, and that system is exactly what we're breaking down today. Because growing a small portfolio isn't about luck. It's about structure, discipline, and understanding how compounding actually works in the real world. Before we get into it, quick note: if you're starting out and don't even have your first investment yet, there's a simple way to get moving. Right now, you can get a free share worth up to £100 when you join, using the link in the pinned comment. It's one of the easiest ways to get your first position in the market without risking much of your own money. But the real value isn't the free share. It's what you do after. If Warren Buffett had a small portfolio in 2026, the first thing he would not do is try to get rich quickly. This is where most people go wrong. They think small money needs big risk, so they chase options, crypto pumps, penny stocks, anything that can turn a small account into something big overnight. Buffett has spent decades warning against this exact mindset because mathematically, when your portfolio is small, your biggest advantage is not speed, it's survival. If you lose 50%, you don't just lose money, you lose time. And time is the most valuable asset in compounding. So instead of swinging for home runs, Buffett would focus on consistency. He wouldn't ask how to 10x the portfolio. He would ask how to make sure it keeps growing no matter what the market does. Most people think Buffett is all about picking individual stocks, but if you actually listen to what he recommends for average investors, it's much simpler. Index funds. He has repeatedly said that most people should just buy an S&P 500 index fund and hold it. Why? Because it removes the biggest risk of all for you. You don't need to predict which company will win because you own all of them. You don't need to time the market because you stay in the market. If Buffett started with a small portfolio today, he wouldn't waste time trying to outsmart Wall Street. He would own it. But buying an index fund once doesn't build wealth. Consistency does. Buffett would automate everything. Every paycheck, a fixed amount goes into the market. No emotions, no second guessing. This is dollar cost averaging, and it works because it removes timing risk. When prices are high, you buy less. When prices are low, you buy more. Over time, the average works in your favor. The key is that you don't stop. Most people invest for a few months, then the market drops, and they quit. Buffett doesn't quit, and that's the difference. Now here's where things get more nuanced. Portfolio size matters. If you have $1,000, diversification isn't your priority, growth is. Buffett has said that diversification is protection against ignorance, but most people misunderstand that and take on too much risk too early. So what would he actually do? He would keep it simple. The majority of the portfolio, around 80 to 90%, would go into broad index funds. Then a small portion could go into individual opportunities, but only if they are deeply understood. Not because of hype, not because of trends, but because the fundamentals make sense. At the same time, Buffett wouldn't just focus on investing money, he would focus on generating more of it. If your portfolio is small, your returns won't change your life yet. Your income will. A 10% return on $1,000 is only $100, but increasing your monthly investment from $100 to $500 changes everything. Buffett understood early that the market is a multiplier, not the source. So if he started in 2026, he wouldn't just study stocks, he would work on increasing his income, building skills, and creating opportunities that allow him to invest more. There's also a psychological challenge that comes with small portfolios. It feels slow. You check your account and nothing seems to happen. No big gains, no excitement. It feels like you're stuck. This is where most people quit. But Buffett wouldn't, because he understands that the early phase of compounding is invisible. The first $1,000 is hard. The first $10,000 takes time. But once momentum builds, everything accelerates. The people who succeed are the ones who stay consistent long enough to see it. If Buffett looked at beginners in 2026, he would warn them about common mistakes. Constantly buying and selling, trying to time every move, chasing hype, and checking their portfolio every hour. These behaviors destroy returns, not because the market is against you, but because your behavior is. Buffett's real edge isn't just knowledge, it's discipline. He does less, but he does it better. So if we simplify everything into a clear playbook, it comes down to this. Start immediately, even if it's small. Automate your investments so consistency becomes effortless. Focus on low-cost index funds to remove unnecessary risk. Keep speculation limited and controlled. And most importantly, increase your income so your investments can grow faster over time. And remember, if you're still on the sidelines, you don't need thousands to start. You can begin with a free share worth up to $100 by using the link in the pinned comment. It's a simple way to take that first step. Because at the end of the day, the biggest mistake isn't starting small, it's not starting at all. If you found this valuable, drop a comment with your current portfolio size and where you're trying to go. And if you want more breakdowns like this, real strategies with no hype, hit subscribe. I'll see you in the next one.